60,000 index. So very, very flattish trends, very, very flattish start is what we have. The Nifty heat map will give you a quick sense of how we are starting. The IKS block has happened. Stocks only marginally lower. Was up 8% day before yesterday, was down 8% yesterday, and is now a little lower after the block. 35 points lower on the Nifty. More down than up is what you have at this stage. So yeah, I mean, IT names are a little lower. And I see Aisha Auto did well yesterday. The large 3-4 auto names did well yesterday. So we'll see if that is the case today as well. You know, so with IT, one thing to remember is that Accenture reports numbers, I think, tomorrow in the US. So I think that perhaps that's always an event, a bit of an event for Indian IT services. Apart from that, I don't really see anything out there influencing things. But you got a bit of a downdrift for IT stocks. Surabhi.
You know, this is not a bad start, considering I'm looking at some of the regional markets. Hong Kong is down 2% right now, so we are absolutely flat. So we're probably the best performing market in Asia as we speak, and there's a little bit of a flash of green as well on the Nifty. So not looking bad at all. In terms of individual stocks, Tech Mahindra is showing up, and that's thanks to that Morgan Stanley downgrade that Nimesh just pointed out. It's the weakest stock on the Nifty. Morgan Stanley has cut its rating on Tech M. It's actually upgraded Wipro, but Wipro is not exactly, dancing on this. Actually, it is dancing now. Wipro is up 1%. So Wipro up, Tech Mahindra down. That's the Morgan Stanley impact on IT stocks. Beyond that, I'm just checking Trent to begin with. They had that investor day. Stock is flat, not doing anything. So quiet on Trent. Let's see what the other trends are. Infosys is slightly lower as well. HDFC Bank, ICICI Bank, the big boys are sluggish, as of now at least, early in the morning. Nestle, Asian Paints, Eternal, a couple of consumer stocks are also on the weaker side of the screen. On the flip side, however, the auto drive is continuing. Eicher Motors, Hero Moto, Bajaj Auto, all these stocks are still flashing some green. Wipro, I've already mentioned. Titan is seeing a little bit of buying this morning, 0.5% up. And then it's fairly quiet. Everything else is in between, little change. But those are the early trends, 20 points lower on the Nifty, Nigel.
One of the big movers today is ESAF Small Finance Bank. They are going to be selling 735 crore bad loan pool to an ARC, and the board has approved the deal. So that's why ESAF Small Finance Bank, that's the one. ESAF, that's the one that's up close to around 7-8%. One of the big volume movers this morning. So just keep an eye out on that one. The other stock that's moving around is Sterlite Tech. It took a bit of a break yesterday. It's gone back to its winning ways. Massive volumes. Remember, I think in the last 1 week, the stock is up 30%. Today as well, it's up close to around 5.5%. And post that order win, the street seems to be getting back to its liking for the stock because it's seen a big rally. The other one that I'm looking at is Reliance Infra. The street is quite excited about the defense opportunity that it's throwing up. So that's why yesterday as well it was up 5%. Today as well it's up close to around 3.5%. And volumes as well rather large on that particular name. So big move is what we're seeing out there. What's not doing too well? Electronic Smart, well, that's down close to around 3.5% approximately. So that's coming for some profit taking. And volumes are rather large on that one. And IKS, well, that's still down close to around 3% as we speak. But as we mentioned earlier, it was lower yesterday. It's trading close to the price at which the block got closed out at. So let's see whether or not there is some buying interest. Keep in mind, it's a stock that was at around 2,100 rupees post-listing as well.
Well, absolutely. And keep an eye out on this one as we go forward. IKS, interesting sort of business. The other one in that similar kind of space, not exactly same, is Sagility, which I think both of post-listing not done too much in terms of price action. We'll talk more stocks in a bit from now. We have Sanjeev Prasad, the Managing Director and Co-Head at Kotak Institutional Equities, now joining us with what he's making of things. Sanjeev, always a pleasure having you here on the program. Thanks very much. So what's top of mind, Sanjeev? The market's almost like Teflon coated. And not just our market. I mean, I'm talking about global markets, right? Flare up in Middle East, and I think there's a fair bit of recency bias as well, that nothing really, all these things will pass quickly. Although oil prices are up $15 since the time this this has happened. Your thoughts, Sanjeev?
Well, that's the state of the play, I guess, at this point in time. People have been pretty bullish for the last 4 years now, and until recently, the strategy worked. Any panic, any negative news, people have bought into that. Buy or dips have been the strategy, which has worked okay until now. But having said that, if you look at India, the performance has been pretty bad actually over the last year or so. If you look at MSCI India index, it's actually flat in the last 1 year versus about 11% return both for the MSCI emerging market index and the MSCI world index. So it's actually been a big underperformer. Even if you look at the last 6 months, pretty much the same situation. It's been a flat market in dollar terms against MSCI World Index, which are 5%, MSCI Emerging Market Index, which are 9%. So it's really been a big underperformer. Even if you extend it to the broader markets, let's say the mid cap and small cap, even there's a problem. Nifty is up 6% in rupee terms last 1 year. Nifty mid cap 100 index, if you look at that as a benchmark, it's about 5% up. Small cap index about 1% up. So that's the whole issue. The market is definitely quoted, but it's not gone anywhere for the last year or so. So on the one side, you have a lot of hopes, on economic recovery, earning recovery, bullish sentiment, and so on and so forth. On the other side, you have the reality of very high valuations, which have probably resulted in not much of returns as far as the market is concerned.
Sanjeev, hi, morning, great to have you on. So absolutely in that valuation debate, that's a point well taken. But if I park that debate aside for just a second and just talk about earnings. Last time when we spoke, I think it was in May, you had told us that you were expecting roughly 10% earnings growth in FY26, which is at the lower end of the analyst spectrum. Since then, the one thing that's changed is a very generous RBI with this bazooka of rate cuts, CRR cuts and whatnot. Does that make you any more optimistic on a pickup in consumption, maybe better earnings growth? Anything that's changed since you heard from the RBI?
A lot of change, unfortunately, the negative also. No, on the one side, you have RBI, whatever it has done on the monetary side. But on the other side, whatever hopes there was of, extra benefit to India on the fiscal side through lower oil prices, that's completely gone away. Now, coming to the earnings part, and we'll talk about the monetary and fiscal later on. As of now, we are looking at about 12% growth in Nifty 50 index for FY 2026. But do keep in mind the fact that almost 2/3 of the earnings is coming from very specific sectors and factors, namely metal mining sector that contributes to almost slightly more than 20% of the incremental earnings for the Nifty 50 index, and that is largely linked to the fact of higher domestic profitability for the steel companies compared to FY 2025 when profitability was on the lower side. This is all linked to safeguard duties. It's got nothing to do with the performance of the economy. Same way, if you look at oil and gas sector, that contributes to almost 30% of the incremental profits. That's again coming more from ONGC's gas pricing formula. And then you have telecom sector, that again contributes about 11% of the incremental profits. That's coming on the back of expected increase in outputs of the telecom sector, that is RP. So it's got nothing really to do with the state of the economy, actually. On the other side, if you look at consumption, it's been weak. The hopes are that it will recover as we go forward. There are a few triggers out there, one which you already talked about, RBI rate cut. But do keep in mind the fact that, it is done. 100 basis point is what the RBI has delivered in this rate cutting cycle, and that's it. 100 basis point rate cut doesn't change anything as far as the household EMIs, etc. is concerned, especially if you look at the low price, low tenure tickets. It doesn't really matter actually as far as EMIs are concerned. Then there is some hope of recovery in rural, which is ongoing. Thankfully, we had a decent 2024 summer crop, decent 2025 winter crop. Expectation that 2025 summer crop would also be fine, linked to a good monsoon. You had some tax cuts, which is positive for at least upper middle income, high income households. But that's about it. The biggest structural issues which we have been constantly highlighting, creation of good quality jobs, it's still not really picking pace.
That's important, Sanjeev. It's really important to hear you say that. I'm just reiterating for our viewers. The view that you have is that 100 basis points rate cuts don't do much when it comes to disposable incomes within households to drive that consumption spend. There's the income tax cut. There's also some hope building up that we'll get some sort of a GST cut this time around when the council meets. They'll rationalize some rates, maybe do away with some slabs. But basically, I mean, to complete that point, short point is you don't see a big pickup in consumption. Is that right?
It's everything little bit, it will add up, but it's not going to be a big recovery. So as I said, there are three, four factors that will all add up to some recovery in consumption. But on the other side, look at what's happening on the investment side. There's a clear slowdown as far as the government budget is concerned. You look at the central government numbers, looking at 7% growth overall. A lot of that is also coming from non-traditional capex items, which probably will not get spent. And all this fiscal hopes, in fact, we were also very hopeful until a week back that it could be some stimulus coming on the fiscal side. In fact, we written a big note on this, how much potential savings could be there because of lower crude prices and how much of that can translate into higher additional, household saving if the government was to choose to pass on, the benefit of lower global crude prices to household through cuts to retail prices. Unfortunately, that story has, disappeared in a matter of a week, right? Given crude prices have jumped to $75 a barrel now. Compared to when we written the note, it was $65 a barrel. $10 a barrel change is about $17 billion negative impact on the economy. The whole thesis of a big improvement in, households' ability to spend linked to lower crude prices, lower, diesel gasoline prices, that's evaporated now. And that's the whole challenge over here. So we were hopeful that between a combination of monetary stimulus, which the RBI delivered, and some fiscal stimulus, which could come on the back of lower oil prices, and some, minor, positives on the consumption side that we just discussed, there could be some recovery on the consumption side. But unfortunately, monetary side is done, in my view. Fiscal doesn't look like there is any scope to do anything, given where food prices are. And whatever small recovery you can see on the back of other small things, fine, that will continue.
Hi, Sanjeev. Good morning. Good to hear your cautious commentary this morning. Growth and earnings growth of 10 to 12% on the Nifty. The markets have gone through a time-wise correction, consumption not picking up as well. But there'll be a couple of pockets, Sanjeev, that you like. If you could name a couple of them. I think in the past you were comfortable with the insurance companies, and they actually have done quite well. Do you continue to hold on to that positive stance? And since we're talking about BFSI, I think even from the financial basket, I think the PSU banking names is something you like. You continue to like both these two?
In the last 12, 18 months, we have been quite positive on the entire BFSI space. Banks and NBFCs, insurance, and thankfully they have done reasonably well. So in the context of the broader market, we are still okay with that space. Also, the stocks have done well. The valuations have now become, I would say, somewhere getting to fair territory, at least for the large cap, private banks. I don't think it must go for re-rating. Having said that, given what we are seeing on the deposit rates, thankfully, it looks like banks are in a position to cut deposit rates at the same time, because there was one worry which was building up was that there would be a big squeeze on the NIMs of the banks, especially the private banks, which have a large portion of their lending book linked to external benchmark linked rate. Yeah. But given the fact that even the PSU banks seem to be cutting savings deposit rate, at least that gives some flexibility to the private bank also now. So hopefully you won't see that big a squeeze on the NIMs compared to earlier worries. Credit side, we are not seeing any real issues, especially in the secured book. It's absolutely fine pretty much across the banking sector. So if that is the construct, then I think banks still look okay. Valuations are reasonable, I would say, not much scope for re-rating. But having said that, as long as the books are growing linked to the ROE, most of the PSU banks will do about 11-12% ROE in FY 2026. Private banks will do somewhere between 13 to 16%. So if that's the return I'm looking at, assuming no re-rating, de-rating, that's a fantastic return for this kind of a market. NBFCs seem to be in a good position linked to the attractive interest rates. So possibly could see some margin expansion over there, but I won't be too hopeful because RBI is pretty insistent. Looks like that there could be a quick transmission of lower interest rates to the broader system. Insurance, we kind of like it's a good long-term structural story. Valuation are reasonable. So yeah, so BFSI space still very, very constructive, I would say, in the context of the fact that other sectors' valuations are very, very high, especially the entire consumption market. At least I struggle with the valuations over there.
No, absolutely. By the way, the number one volume-led gainer today, once again, is Sterlite Technologies. Sterlite Tech is up almost 10%. It'll come up on your screen. And like a one-way rocket move. And we've had many of these, right? I mean, down and out, but complete, how do I call it? I mean, change of fortunes very quickly. So from 60 rupees, on the 10th of May, stock's at about 115 odd rupees now. And of course, bulk of this move has come in the last 5 or 6 odd trading sessions. The BSN order, of course, came through. But still, I mean, it's a very, very large, significant move. Apart from that, I mean, there is Power India, which is up 2.5%. Data Patterns is up at 3%. Jubilant Ingreva, another bit of a turn has been Reliance Infra. I think continues to power ahead. 30%, 35% this year so far. Reliance Power is up even more, 60, 70% this year. I guess people looking for... it's also a reflection of, I guess, the lack of ideas that, you're having to look harder and harder and harder. Is that the way you look at it, Sanjeev? I mean, some of these big turns, suddenly we've had many of those in the recent past.
I won't get into specific stocks, but there seems to be a lot of excitement around some of these, I don't know, you call them whatever, I call them narrative stocks, whether they are a defense space or, railways, etc., etc. There seems to be a lot of excitement around these names. I mean, the problem is, many of the narratives simply do not stack up. Look at railways as an example. I did a note also on that. What is the excitement for? I have no idea. For the simple reason, if you look at the government's railway budget, it's flat for the last 3 years. FY 2024, FY 26, it's stuck at 2.6 trillion rupees. A lot of low-hanging fruit as far as railway capex already done in the form of existing network, whatever maximization had to be done, and large parts has to be done. Electrification is now up to 90% of the railway network compared to about 50%, if I remember correctly, in about 2015, 2016. Yeah. Same way, a lot of investment has been made in signaling, safety systems, etc., which has resulted in faster passenger and freight train movement, which has resulted in ordering of more railway stock, rolling stock, that is, coaches, wagons, etc., etc. So a lot of that thing is done. If you have flat capex as far as railway budget is concerned, why should there be excitement on railway stocks, first of all? And more importantly, look at the valuations of many of these railway companies. You look at something like Rail Vikas Nigam as an example. It's a $10 billion market cap company. Its PBT in FY 2025 was about $200 million. I mean, what sense does it make, to be honest with you? It's trading at about 8-9 times price to book. But huge excitement over there. IRFC, $20 billion market cap company. It's a railway finance company. The loan book has been flat. Profits have been flat. Trading at more than 3.5 times price to book. The private banks don't get that kind of multiples, right? And here I have a wholesale borrower, wholesale lender model getting 3.5 times price to book. There are a lot of such funny stuff happening in the market, maybe linked to whatever sentiment, but at least I am not in the camps that I want to get into any of these names, far away from these names.
Okay, all right. Point well noted that you will be far, far away from a lot of these names that have been, well, I mean, someone will call them hype stocks, narrative stocks, but they've really been, capturing or captivating investors' imagination. Thanks very much. Great conversation as always, Sanjeev. We look forward to the next one. You have a good rest of the day. Well, with that, quick eye on the market, and the market's absolutely flat and quiet, not doing anything at all. 8 points up on the Nifty. Now, one of the sectors that Sanjeev, though he's very cautious on the overall market and valuations, one of the sectors that he is bullish on is actually BFSI. So good time to then have a conversation with one of the biggest BFSI companies of the country. Shriram Finance is on our radar. How is this year shaping up for the company as those rate cuts percolate through the system? Well, let's discuss that and more with Mr. Umesh Revankar, Executive Vice Chairman at Shriram Finance. Mr. Revankar, good morning, sir. Great to have you on. Every time we speak to stock market experts, they tell us the one sector to focus on is BFSI because that's where things are lining up quite well. Now, you tell us, translate that in terms of numbers and what you're seeing on ground and how you're expecting the rate transmission cycle to impact you. The cuts that have happened, the CRR cuts that will come through soon enough. You've guided for, I think, about 15% growth, AUM growth for this year. Will it be more back-ended, front-ended? Which are the segments where you're seeing good, demand pick up? Just give us a broad sense of how the monetary transmission will play out and what it will mean for Shriram.
Yeah, good morning. I think it will take a while because normally June, July are not the peak of the state. August 15th onwards or after typically things move up on the the other demands. Even the inflation goes down during this time because of heavy rains and we rain little.
Oh, I think we'll have to reconnect that line. Yeah, maybe it's all the rains, the heavy rains that he was talking about. Those heavy rains have been lashing Mumbai as well. Maybe that's kind of playing up with the telecom lines. We'll try and get him back very, very quickly. I'm just going to quickly recap what we know from Shriram Finance so far, what they've guided for. Their guidance is that loan growth in the current year, FY26, is going to be around 15%. They're expecting CV to grow between 12 to 15%. PV growth, they're actually expecting it to be stronger, 20%. And some of the other segments like MSMEs should fire up for them at a good rate as well. About 20% is the MSME growth. And the NIM guidance so far that we have from the company is between 8.5 to 8.6%. And that's what we were trying to understand, that's the overall guidance for the year. But what happens, as we go through the 4 quarters? Remember, there are giants like SBI that have said that it's going to be a U-shaped recovery for NIMs. Initially, there'll be a sharp drop in NIMs as the rate cuts are passed on. But then at least SBI is expecting a good recovery because the CRR cuts will kick in. They'll cushion the impact on the net interest margin side. So that's one segment. The other segment, obviously, is gold loans, which is where a lot of NBFCs, including Shriram, of course, are getting active. So we will talk about that soon enough. Well, before we get Mr. Revankar back, maybe a good time to go back to the market and just see what's going on. Let's try and pick some stocks because the indices are absolutely flat. Now, in terms of stock action, Jubilant in Griva, 5% up on that stock. Sterlite Technologies, of course, Prashant had mentioned earlier, Sterlite is still up 7%. By the way, this week Sterlite is up 34%. And it's all thanks to that BharatNet order, which is getting the market so excited. Sterlite Tech really is a stock of the day, the week, perhaps the month as well. Phenomenal move on Sterlite Tech because of that big order win. I think we've got Mr. Revankar back. Sir, sorry, the lines, we couldn't hear you very clearly, but you were explaining how this is a bit of a lull period because of the monsoon. So just tell us, in terms of a pickup in loan growth and also on margins, how will this monetary transmission play out?
I think it will take a time because what happens in the capital market is yet to respond to that. Even though banks have passed on some rates, typically NBFC have around 20-30% of the borrowing from the bank and rest of it from the capital market. And it is not that the entire liability get transmitted that rate reduction. I think it will take a while, and maybe over 6 months, the rate reduction will get transmitted to the NBFC liability, and some of it will definitely pass it on to the customer. So customer demand to revive and the overall credit to go up, I think it will be during the peak season, that is October, November onwards. So the second half should be much better for growth.
Revankar, good morning, Prashant here. We were just having a chat with a banking analyst earlier today, and we were saying around 12% is where they're at. We're under 10% now, so it's sharply lower compared to the same time last year. Expectations are that things will pick up north of 12?
Yes, I think the demand should definitely pick up. That's what I was suggesting, that second half should be the time where the demand should be picking up. Because of good monsoon, even the rural demand will keep going up. And the infra demand will pick up significantly is what I strongly believe.
And you were referring to rains earlier, Mr. Revankar. I think and that is important, right? Overall, always important that we get good monsoon rains, and the forecasts are that it's going to be above normal.
Now, 2 consecutive good monsoon and above normal is definitely very good for the rural, and MSP price also are increased for 2 consecutive years, and that will augur well for rural consumption and rural demand.
Just one more question. Underlying demand, and it'll pick up. There are lots of variables. But 2 conversations we've had recently, one with Chola, they gave us a pretty sober assessment of what's happening on the commercial vehicle side. The second is we spoke with C8 yesterday. And again, they were kind of sort of across the board, they were saying replacement is okay, but otherwise, new demand is pretty lackluster, pretty soft. So just wanted to you to respond to that.
Yes, so basically what's happening is because of the price increase in the vehicles, almost all vehicles, price increase has been around 30%. So when price goes up steeply, the replacement cycle will become slower. So average holding of a vehicle today has gone up to around 9 years against around 7 years. That means people are holding on to the vehicle longer than in the past because of the steep increase in the prices. So people have to come to that what called comfort of buying a newer vehicle, and that cycle will restart is what I believe strongly, because world over the average age of the vehicle comes down to around 7 as the economy picks up. So I feel the CV cycle is still on the way up. It is not reached the peak. So maybe another 2 years of good CV cycle should continue is what I strongly believe.
All right. Hi, Mr. Revankar. Quick couple of questions before we let you go. The last quarter, you reported a technical write-off. Any such surprises we should expect in this quarter? That's quarter 1 FY26, if you could give us a hint. And also, from the write-off that you've taken in the past quarter, any kind of recoveries should be reflected?
Recovery, yes. See, it is basically the accounting change. We decided to have a write-off of the accounts which are at more than 12 EMI outstanding. So it's a one-off, and it will not be, once the policy is set in, it will continue to remain. So there will not be further, surprises on that. But yes, the recovery we can see over the period. Some recovery will be reflected in our results every quarter.
Okay, all right. You want to quantify it, sir? Quantify the recovery?
Quantify it is difficult to make because, especially in the first 2 quarters.
All right.
Third and fourth quarter, definitely there will be.
Very quickly, before we let you go, the smaller part of your business is gold loans, and that's degrown actually in the past year or so. Now, the RBI has given a bit of a booster shot, peppered the segment on the whole. Any plans on increasing contribution from the gold loan segment, or you would like it to be a smaller part of your business itself?
Now, gold loan definitely will go up in our overall share of the asset side because we are focusing on that. And not only that, there is a lot of loans which are hitherto was going to the unorganized sector or pawnbrokers segment. That will come back to formal sector. So overall, all the NBFC and banks will benefit out of this.
All right, Mr. Revankar, thank you very much for joining us. Good speaking with you. Appreciate it very much here on CNBC-TV18. Let's shift focus and get you a sense of what's happening on the M&A side. Blocks galore every day, single day. So lots of supply hitting the street, promoters, early investors, private equity, you name it. What about actual M&A transactions? Will we see a pickup there as well? I think that's the question that we want to address, and we'll sort of talk about all of this. We have 2 gentlemen really at the top of the food chain as far as investment banking in the country goes, Nitin Maheshwari and Ravi Shankar of JP Morgan. Both are managing directors and co-heads for their India investment banking business. This is JP Morgan. Gentlemen, great to have both of you here. Thank you very much for joining us. With regards to JP Morgan, there is the SMBC's acquisition in Yes Bank. I think the JPM team was involved on SMBC side. The other one was the CET acquisition, of the recent acquisition in Canada which you did. I think you guys advised CET. Correct me if I'm wrong. These are details.
No, we didn't advise.
You were not involved.
But
okay.
There's a lot of action going on, but not that one.
Okay. Tell us a little bit about what the team has been up to on the M&A side, and then we'll sort of spread out the discussion on IPOs and capital market transactions.
Yeah, let me take that. First of all, thank you for having us here. So what's happening on M&A side, if we think of our client sets, right, there is the inbound M&A where private equity has been the most active. And there are 2 specific areas, the Japanese inbound into India and the Middle Easterns, right? So that's 2 areas of inbound. Outbound, we're starting to see selectively our clients picking spots, picking areas of expertise or technology, and then making those acquisitions. These are not multi-billion-dollar acquisitions, but these are small niches which our clients are buying into. And third one, private equity, where we're trying to see It's continuing to see, let's say, consistent activity, which is driven by confidence in businesses, confidence in talent, and ability to exit, which is what's driving a lot of the M&A deal activity right now.
How is it compared to the last couple of years? I mean, volume-wise overall?
So volume-wise, I would say this year is as good as the last year. Now, given the activity in the public markets, that public market alternative obviously has taken the front seat, but we are seeing public markets actually enabling M&A, as it gives confidence to our clients to go make acquisitions, gives confidence to exit investments that they've made. So public markets as an enabler, but volume-wise, I would say it's consistent over the last couple of years.
Now, gentlemen, I'd want to sort of bring in the whole Trump effect and how that's shaping and reshaping your world. Just thinking out loud in terms of common logic, you'd imagine that with so much conversation on shifting supply chains and where you need to have additional presence, if I'm a manufacturer and I'm going to be hit by tariffs, I'm guessing some of those conversations are starting about whether I can buy an asset in a geography which is perhaps less affected by tariffs. I don't know. But, I mean, are those conversations happening? Do you expect M&A to get a further boost just because of the way the trade disruption is shaping up around the world? I don't know, Ravi, Nitin, anyone?
Yeah, no, absolutely. So look, I think this is actually a very big theme right now in India, and I think it's a once-in-a-generation opportunity for Indian entrepreneurs to really take advantage of the supply chain disruption and the China Plus One strategy. Yeah. And I think the other boost they are getting is the way their own stocks are trading, which gives them the acquisition currency to go and acquire things overseas, which are actually trading at a low multiple. So I think they're both the opportunity and the currency that they have, and both of them we are already seeing a lot of activity and discussions.
So which are the hot sectors? Where do you think we'll actually see some M&A action, maybe outbound this time, as Indian companies redesign their production?
I think manufacturing, electronics, a lot in the supply chain around rare earth. I think all of that will be highly
And which
attractive.
are the target geographies where we might see some announcements?
So we see Europe, we see a lot of activity in terms of outbound, simply because there are a lot of assets which are owned by families which are going to come up for potential exits. So that's where we are seeing most of the action.
And just, again, I'm sorry, bombarding you with a lot of questions here, but just because this is the new thing and we should be prepared for what we see, maybe. So we're talking about a gestation of what deals within 6 months, 12 months? What would be the average size of these very small ticket niche acquisitions, or could they be ambitious buys as well?
Look, I think Indian corporate has been very disciplined about it, but at the same time recognizing the potential. So I think it won't be the $20, $30 million. At the same time, we are not looking at multi-billion dollar transactions. So I think you think about it, $500 million to $1.5 billion, $2 billion, but I think that's how you'll think about it.
All right. Hi, gentlemen. Good to have you all in the studio. Thanks a lot for coming down. Well, Nitin, I'll come across to you. You know, we thumb the table and say that the domestic liquidity is very, very strong. The SIP flows as well have been moving up. But on the flip side, if you just look at the last few sessions, you'll see on a day-to-day basis, it's close to around $1 billion of paper supply that's coming in there. Wow. I, for one, I'm looking forward to that earnings season just to see this stop, because the kind of supply actually is getting excessive. How do you read this? One would say the depth of the market is good, but the problem is it's getting a little bit excessive. Your turn.
So in terms of, if you see the number of large transactions that are coming, and we've been involved in a number of those, we're seeing that as a consistent shift of ownership of companies by large promoters / MNCs into the public institutions or the public shareholders. So it's a natural shift that any market goes through. So there should not be anything surprising about that. But if you compare, let's say the last 6 months volume is $20 billion, the SIP flows or the domestic institutional flows is close to 35 to 40. So from a demand and supply perspective, we're in a reasonable zone. There are a number of big companies who are looking to access public markets in the next 6 months. So we are not seeing that imbalance, to be honest. It's a natural
You wouldn't
shift.
be worried as of now?
Not at all. As of now and later as well. For all the supply we see from our clients, I think there's reasonable demand from institutions who want to own some of these high-quality companies.
And we should not take eye away from the fact that while there is a $60 billion roughly capital funds flowing into Indian public market from domestic, there's a $40 billion private equity capital coming every year into India. And that's, in a way you can consider FDI, but it also kind of Woolberg against how public market kind of goes up and down. So I think that's a total of $100 billion, which is out there.
Either if you want to take it, not exactly your domain, but this FDI question, right? Any way you cut it, when FDI flows have been coming off very sharply. How do you? I mean, is there a nuance here, or are they just coming off? I mean, what's the sense?
Look, again, it's the way you define FDI. To our mind, private equity putting money in India is also, in a way, FDI. Now, if you look at total basis, I don't think there's a big kind of up and down. But for sure, depending on the cycle, you will see a US or European company focusing on kind of local markets simply because there's so much happening in each of these markets that sometimes they just need to focus there. But broadly, if you think about India as an emerging market, just the macroeconomic stability it provides, in no geopolitical tension, and then the kind of policy stability, I think this is a market where people will come back to again, and this will continue to flourish.
Any thoughts on that?
I would say just one thing which is relevant for global MNCs in India and Indian MNCs outside India. You're looking to do business where you already have a meaningful presence. So MNCs which have been here for a long time, they are continuing to invest. Now, whether that investment is through M&A or not is, in my view, irrelevant. They're investing in new capacities, they're investing in talent, and same thing for Indian MNCs. So I think FDI is I won't look at it in number format with respect to, let's say, whether dollars are coming in or not. The fact that Unilever or Nestle is investing in new capacities in India is also FDI. I think the good news is that the businesses are so large that they're able to fund their growth through their own currency. Right? If they have to make an acquisition, they can use the Indian capital markets to fund that. Is an important aspect of evolution of our market. And that's how we should think of FDI.
Just one, what Nigel said about all these, just to go back to that blocks question. Have you looked at what promoters and especially promoters are doing after they sell their shares? That'll be an interesting thing.
Enjoying life? Sorry.
Are they already enjoying life? Are they buying, and this is
rooting it back into the...
Yeah. Are they buying other equity diversification for themselves? Is there any
No,
data?
absolutely. So look, I think if you look at some of the large groups which are going and acquiring things, obviously that needs to be funded. So if somebody is investing in a Coca-Cola bottling business, they need to fund it, and that's where they're seeing capital coming out from one of their portfolio companies. So I think that's the common theme we see across across various segments. So it's not that they're taking it away
and no entrepreneur is relaxing. They're using that money and reinvesting in new business initiatives.
That's good to know. That's the bottom line. That's really good to know. But gentlemen, you're in the thick of the deal-making business, right? And I have to ask you about the price and valuation question, because that's, I think, top of mind for investors into this market. We keep hearing this, that valuations are never cheap in India. And this is a time when we are seeing a lot of exits. Stage one investors, private equity, or even promoters for that matter. What is your interpretation of valuation? And this is happening at a time where the firepower or the powder with domestic institutions, it is coming down. I mean, they're maintaining a brave face, but from getting 40,000 crores every month, now they're getting less than 20,000 crores. So in terms of the supply, the pricing, and those conversations, how do you rate the dynamics?
So look, I think if you look at just the MSCI India versus MSCI EM, and you go back 10 years, India has always traded at a premium, anywhere from 50 to 80%. So this is not a near-term phenomenon driven by a certain capital flow. This has been there for a long time. It's across sectors, and we have done time series charts on that. The other thing is what is driving it. I think that's more important than what's the difference. And I think what is driving it is India is one of few markets beyond US and China where you have a large domestic market which is kind of immune to a little bit of whatever happens globally in terms of whether tariff, whether it's trade disruption or geopolitical tensions. And I think that's a big positive for us. And then when you put that together with the $60 billion capital which is flowing in, where savings is moving from your fixed deposit and real estate to capital markets, I think that creates a big stable factor. So I think all of that is quite positive. And if you look at just Nifty, right, PE, which is at 21, 22 times today, and compare it to S&P 500, are we not going to grow better than US? I think, GDP is faster. So I think just goes up in that direction.
So just a follow-up, do you expect supply to remain as heavy as it has been in the last couple of months? And the part B to that question is that do you expect the market to absorb it as well as it has in the last year or so?
So look, if you look at last year, it is an interesting fact. 1 out of every $5 raised in IPO market was in India, which is quite an aberration, right? You'll think. 1 out of every $10 raised as such an equity was in India. Now, whether it will continue the same ratio, no. But I think that will be more reflective of where US market will come up. But India, we think is a secular growth. I think it will continue to grow at high teens. if we are growing at double-digit nominal GDP growth, with the dynamism we have in our entrepreneurs, I think it's going to be like that.
Ravi, you're making me feel good about where I'm putting most of my money. So that's good from an India market perspective and a longer-term perspective as well. But Nitin, I'll come across to you. Where do you see a lot of excitement with regard to M&A activity? If I look at it in the last few years, there's been a lot of activity on cement, a lot of activity on infra as well. You had a couple of big buyers out there. If you just pick a theme where there's things are heating up out there, because when markets get dull or uncertain, there's a lot of inorganic growth that picks up. So any particular segment that you see?
So maybe a couple of sectors. So one, we see enablers of this India growth, which is infrastructure and financial services. So those two areas have remained active. We spoke about Japanese inbound investments into India, for example, in financial services. Infrastructure is very well owned by now institutional investors now, the infra funds. So that's one area. Technology, within that, IT services remains a favorite area for private equity because of everything that it has to offer, despite what we've seen on demand questions that were there last year. So we do see activity coming through. Healthcare has been very busy. We are underpenetrated on the services side, and we have a very robust, place around the manufacturing side. So we do see that continue to remain active. So there are different pockets to these segments where we will continue to see M&A. Now, within that, the flow of traffic, whether it's inbound, outbound, and sponsors, we'll see. Now, I think the last theme, which is quite interesting, is our MNC clients who are proactively managing their India portfolios. They want to use India for growth. They want to also use India for global growth in a way that, is there a path for us to monetize X% stake and use that capital to reinvest in another market? So these are active dialogues which will continue to drive activity across both M&A and public markets in our view.
Do you guys broadly think outbound M&A will kind of, people will be a lot more careful, right? Because there's so much change. You don't know who's going with who and who's talking to who. A lot of industrial policy as well. I mean, state-directed, almost deals, which people are trying to engineer, especially out of the US.
Yeah.
You think that'll be a function? Although I think one of you said that maybe into Europe there are more opportunities.
Yes.
The old legacy family businesses, etc.
Absolutely, but those are kind of, again, these are not multi-billion-dollar kind of transaction that people are going to do. I think these will be smaller capability acquisition, geographical expansion, that kind of stuff that we're going to see more than big bang acquisition. And frankly speaking, we don't need that. I think people are seeing so much opportunity in India itself from our entrepreneur perspective that they're going to invest their energy here. And the idea will be, can I get some additional capability outside India and then kind of bring it to kind of get an edge in this market.
Any thoughts on private market valuations? I mean, unlisted, where do they stand compared to public market valuations? Are they?
So they've remained stable, I would say, across sectors. We've seen, let's say, if you were to do the transaction multiples valuation, right, you will see they've been consistent. So they've not, not reached a place where they've come down sharply or have gone up sharply. But yes, we have that discussion consistently on price versus valuation. And we do see there are times when private transactions could happen, let's say, even at a slight discount to the public market valuations at times, right? Given you're selling a large chunk of a company rather than like a small block trade, right? So we do see that discussion. But again, in each sector, there's a different story on that part.
Okay, all right. Very interesting conversation, gentlemen. I think the sum and substance is that the deals market in India, M&A, ECM, it's thriving, it's alive and kicking and fired up with lots of action. Thank you very much for giving us a perspective on the same. Well, that's the JP Morgan view on investment banking and deals here in India. Just very quickly, before we get to our technical expert, Siemens had demerged its energy business, and that demerged business has finally listed. The price is slightly higher than what was the optical or the dummy price, as it's called, which was the calculated price on April 7. And remember, this is one of the largest T&D players in the country, actually the largest, above GE, Vernova T&D and Hitachi. But the others as well, the other stocks are also up and about, almost 2-3% up on the entire complex. So that's the power transmission and distribution sector in focus.
All right, well, let's get to Mitesh Thakkar, though, who joins us to help us out with a quick technical check. Mitesh, tell us, the market's a little bit wibbly-wobbly. The good news, though, is we've recovered from the day's low. However, the broader markets are still seeing some weakness. What's your take? Would you buy into the Nifty? Because we're testing those lower levels, but there is buying that's coming in there.
Nigel, I think the indices, as I've been maintaining, they aren't offering a good trading opportunity. They'll just chop around within a range and I'm not able to see a big directional move coming in. So I think indices is an avoid for me. It's a stock specific trading basis for me. So I'll go with a long on Asian Motors. Keep a stop below 5,400. Look for targets of 5,585 to about 5,600 on the upside. And the other one is a sell on Canara Bank. I think the PSU banks are slightly turning negative. So Canara Bank is a sell with a stop at about 109 for targets of 102.
Okay, all right. Thanks a lot, Mitesh, for that. Well, we'll slip into a short break. On the other side, Manisha Gupta is waiting for us with a commodity market check. Stay with us.
Welcome back. So all quiet on the equity front. Let's figure out what's happening in commodities. We have Manisha now in the studios to tell us what the latest is. Manisha, good morning. Take it away.
Morning, and thank you for that, Sylvia. I'm looking at the crude oil prices because while the Brent is holding around 76, it is the US crude oil prices which have actually surged more, and so much so that the gap between the WTI and the Brent seems to be narrowing right now. It is also because the US inventories have posted the largest decline in almost 10 years. The markets were anticipating perhaps a decline of 2 million barrels. What we got is 11.5 million barrels. And now with that, you're looking at the US inventories trading at around 420.9 million barrels there. Well, apart from that, the US gas stocks actually has seen a bit of an increase, and that's weighing onto the market as well, because this is soon going to be a driving season demand that you will be looking at in US. And with the way the inventories seem to be increasing there, could be perhaps capping gains there. But more interestingly, it is about the geopolitical premium that the crude oil prices seem to be holding. Well, most experts tell us that crude would be at 64, 65 if it wasn't for the war that's happening between Israel and Iran right now. So that war premium stands at $10 a barrel in case of crude. We still do understand that there is a missile exchange continuing between Israel and Iran. And even as there has been a hope that energy in sense of energy facilities, infrastructure and export would not be hampered, but the latest reports tell us that Israel's Bazan oil refinery complex has sustained some damages. Not just Israel, when you look at Iran, well, there as well, South Pars field, which is the world's largest natural gas field, also has been hit and has been, the production there has been partially suspended. So there is some impact now coming in for gas and crude oil in both of these countries there. And this, the market tells us, is the biggest threat perhaps to oil market since Iraq invaded Kuwait. That was in 1990, and then 1974 when that was Arab oil embargo. All hopes and all eyes, perhaps, that nothing really happens or conspires when it comes to Strait of Hormuz there. That is what the street is looking at. Also, there's a lot of statement coming in from the maritime agencies, shipping agencies as well, advising their commercial ships at the Strait of Hormuz to stay away from Iran borders there. It is sailing close to Oman now to avoid Iran waters around the strait there. Interestingly, Strait of Hormuz itself is a 33-kilometer wide within its at its narrowest best, and much of it is into the international waters there. At this point, we do understand that 100 to 120 ships are sailing via Strait of Hormuz. That is the kind of data that has been coming in for last week or 10 days. So no impact as of now on the ship movement, but there are various reports coming in. The Gulf of Oman also is bordered by Oman and Iran on one side, UAE and Pakistan on the other side. So at this point in time, there's nothing that is happening there, but the street clearly keeping an eye on that. In the meanwhile, you also are looking at electronic interference with commercial ship navigation systems. That has been on a surge in the last 1 month, is what reports suggest. And then apart from that, the average earnings for the shipping industry also seems to be surging. Last week, it was at $20,000 for supertankers, which stands at a $50,000 as of early morning today. So clearly, lots happening when it comes to Iran, Israel and Strait of Hormuz.
All right, Manisha, thank you very much for that. You know, just take a look at a few of these smaller sort of defense names. If you can pull up these intradays, Paras Defense, for example, has moved up very sharply, and all of it, you know, I think started in the morning, but of course has picked up a pace. Paras is up 6%. Look at Data Patterns, another one, which is moved up very sharply. Look at DCX, which is again showing a 5-6% kind of a move. Look at Axis Cades, another one which is up about 5% or so. That is one clear kind of, you know, trend that I'm seeing. Idea Forge, that's the drone maker, works with the defense industry, the Ministry of Defense here, 2.5% there as well. So that's one thing to note. Otherwise, I mean, market breadth is kind of evenly balanced, more down than up. 1,400 stocks are lower. Advances are up about 1,100 odd stocks or so. Let's talk about some other stocks which are on the move. Ria is tracking ESAF, SFB and Purvankara. Ria, tell us more.
Well, yes, first let's take a look at Purvankara. The company's wholly owned subsidiary has received a letter of intent for civil works for a residential project in Bangalore, and the contract value for this is about rupees 272 crores, and the stock is up around 6% reacting to this. Moving on to ESAF Small Finance Bank, that one is also up around 8% today after the board has approved the sale of NPAs and written off loans to ARC, which is Asset Reconstruction Company. They're going to sell a total pool size of rupees 735.18 crores as a result of this, and the bank carries an overall provision of 90.1.5% on the above pool. Now, why this is positive for ESAF is that recently banks have faced some stress in the last few quarters. In FY25, they had written off about rupees 1,225 crores cumulatively to clean up their NPA books, and for ESAF specifically, this sale to ARC will help the bank get rid of its bad loans from the book. And the interest from ARC also suggests a scope of recovery for the bank.
Okay, all right. Got that, Ria. Thank you very much for that. Well, with that, we do have to take a very quick break. Come back on the other side in our special segment. It's the economy is coming up. Lata speaks with Mahesh Vyas of the Center for Monitoring the Indian Economy and Neil Gopalakrishnan of S&P Global Ratings about the state of capex in India.
Welcome to It's the Economy. Today, we look at the state of India's private capex. A MOSPI survey, Ministry of Statistics survey, first of its kind, published on April 29th, said that private capex in India grew by 66% over 4 years, from FY22 to FY25. That survey also said that capex will decline this year. Also, the central government capex, after 3 years of hectic spending, will grow more slowly in the current year, as we know from the budget. An S&P Global Ratings report says that India's private capex will nearly double to $800 billion from now to 2030, that is FY25 to FY30. Now, one of the most accepted authorities on capex projects in India is the CMI. So today, to discuss the themes, I have with me Mahesh Vyas, Managing Director and CEO for the Centre for Monitoring the Indian Economy, CMI, and Neil Gopalakrishnan, Director at S&P Global Ratings and author of the report I just referred to. Gentlemen, I think I have the two best experts on private capex. Thank you very much for joining me. Mahesh, you tell me, what is the state of capex? Your elaborate table that you gave me over the last 10 years will run as you speak. I got the sense from that projects announced are rising, but projects completed are not rising that much.
Well, there's always a big lag between the project announcements and projects completed. But, if you look at the 10-year horizon, and for investments, one needs to look that big at a horizon, there is a significant increase in capex in India. So we have nearly a doubling, not a doubling, but a near doubling of investments, whether it is in announcements or in completion. So we used to have about 20 lakh rupees worth of new investment proposals being made every year till before the pandemic.
Yes.
After the pandemic, that number is nearly 40 trillion. So 20 has become 40, which is a kind of a doubling. In the last 3 years, you look at the numbers like 41 trillion, 36 trillion, 42 trillion. So there's a little blip up and down, but nevertheless, these numbers are clearly double of what they used to be. If you look at total completions also, you have like around 5 trillion rupees worth of completions happening before the pandemic. And there were lots of ups and downs, too much of noise. But nevertheless, what we have now is closer to 8 trillion, maybe 7 trillion, 7 to 8 trillion thereabouts. 24-25, we saw a small fall to just 6 trillion. Number may get revised a bit, but still, it was a little slowdown. Nevertheless, if you look at the long picture, both the numbers have gone up significantly, whether new announcements or their completions.
Okay. I take your point, and those numbers were running as you spoke. New project proposals were averaging about, as you said, 20 trillion before 2019. And in the last 3 years, the average is about 40 trillion, the projects announced. That is clearly the case. But if you adjust for inflation, it doesn't look like the number of the actual amount is very good. And especially when you look at completion, where the difference is not very big. Around 5 trillion has become about 6 trillion average in the last 5 years. If you adjust for inflation, it doesn't look very big, no?
Well, you are right, Lata. If you adjust for inflation, it doesn't look very good. But, for a long time, the investment story was so depressing that we are so pleased to see this doubling, even if there is inflation. Mind you, inflation has gone down. So you have to adjust less for inflation now compared to what you had to do earlier.
That's a fair point. That's a fair point, especially because in these cases, we may have to adjust with WPI, and that has genuinely fallen to very low single digits. So point taken, something to celebrate in private capex projects, announcements and completions. That's the word from CMI. Neil, I have this very optimistic report of yours for FY26 to FY30. Can you just give us a word on whether you looked at anything in the previous years, like up to FY26, anything at all that, you saw?
Hi, Lata, and thanks for having me on your show. So the way we came up with our estimate was a kind of a bottoms-up approach where we looked at some of the largest companies. We looked at the announcements made by the 100 largest listed companies in India, and this was across sectors. And to that, we added some of the large unlisted companies, many of which we rate as well, and also looked at a study on capex done by CRISIL Intelligence in India. So what we looked at was essentially the guidance on capital expenditure, which is more short term. Typically, companies give this for a year or two. And we also looked at some of the announced capacity targets of companies over the next 5 years. And that's the way we worked our capex out. And as our study showed, a large pickup in private sector capex is actually coming from the infrastructure sector, where we expect capex to double in the next 5 years. Whereas the industrial sector, which is the traditional steel, cement, and some of the other sectors like telecom, their investments will rise at a much slower pace, on average about 40 to 50%.
Okay. Let me stop you there and come back to you with some red flags. But Mahesh, your any reaction to this? The point that Neil's report makes is that they expect it to double, partly because there are very obvious announced instances in power transmission, airports and aircraft. I mean, those are very obvious. And then there will be the other organic expansions. Plus, they point out that balance sheets are very clean now, both of the lenders, that is the banks, and the corporates which will do the investing. And that's how they base their doubling of capex. Your thoughts?
Well, I haven't seen the CRISIL report to actually make a fair comment on that. With that disclaimer, I may say that to the last point you made, that the balance sheets are very clean. Companies can easily gear a lot more. Their profits have been superb in the last several years. Their debt equity ratio is extremely low. Interest cover is extremely healthy. So the balance sheet of the Indian corporate sector is super. And the banks are also in a good place to lend. But this story has been true for a very long time. And investments by listed companies and large unlisted companies is a very depressing story. Oh. So I did a little study a few weeks ago, and found that if you look at the growth in net fixed assets, outstanding net fixed assets between 2006-07 and 19-20, there was a certain growth rate, and that growth rate has halved since then. So, although profits have multiplied multiple times, it's not a percentage increase, it's a multiples increase in profits. But net fixed assets today is growing at 4% per annum nominal terms. So the balance sheets don't give me any great confidence that the Indian corporate sector, listed or unlisted, I'm talking about a sample of 30,000 companies accounting for a very large part of India's GDP. So that's not...
Okay, I take your point. So what the very good or very heartening bar chart that we played of yours, that total investment proposals have gone up from an average of 20 trillion in the 2010 to 2020 period are up to now 40 trillion. That is largely government capex then. It's not so much private capex?
Yes, a large part of it is government capex and infrastructure and not manufacturing. Infrastructure is largely funded by the government. So you see, government or rather infrastructure accounts for nearly 60% of all investments in India. Okay. Manufacturing is only around 26% or 30%, thereabouts.
Okay. Let me come to you, Neil, on that. On your optimistic analysis of 25 to 30, there are two red flags. One, that government capex will slow. I mean, during the COVID years, we saw that 30% rise and then a 15% rise in government capex. Clearly, FY26, we are seeing a little bit of a pullback. It can't grow because the fiscal deficit has to come down. So would that be a big red flag? And of course, this tariff picture, Chinese dumping, overcapacity, can these two stymie your number?
Right. That's a valid question. And at any point, you would see significant fluctuations if your period of analysis is relatively short. So if you're looking at maybe year-to-year comparisons, you would see a big rise in a year and subsequently, and similarly, maybe sharp falls in some other years. But in our study, what we have looked at is the actual private sector capex in the last 5 years versus what we think would be a potential capital expenditure investment in the next 5 years. So the investment period is relatively longer.
Okay.
And just responding to Mahesh's point, I think it was an interesting observation, and I agree there have been implementation challenges once companies announce projects. But what we have noticed is most of these, and that's something we have highlighted in our report as well, that particularly in the renewable energy space, which is where a significant amount of the incremental investments are coming in, there are material execution risks. But our observation is in the industrial sectors, like say steel, cement, companies have overcome this, and their ability to actually deliver complete projects in time has significantly improved. So for example, if you look at the leading steel companies, I think their execution record is pretty impressive. If I go back to renewable energy, the 500 gigawatt target is appears challenging. And if you look at execution over the last few years, it's fallen well short of where it needs to be. But again, if you look at the recent trend, the last year, at least the industry has been able to add about 25 to 30 gigawatts of capacity, which is probably double what it was in the previous year. And if you look at projects under implementation, it's in excess of 100 gigawatts. So I think progress is being made. There are risks, we don't deny it. But as I said, our numbers are based on guidance from companies, targets given by companies, and there could be a slippage here and there, delay here and there, but we think the ability to execute is improving.
Is better. No, I agree with your ability to execute. What has stymied us in the past is also, for instance, the power sector, DISCOM's not paying. And while it is somewhat resolved, it is not fully resolved. And now you have a new problem. There are companies telling us that Nal Se Jal projects in the last 1 year are not being paid for. So, you know, those government-dependent projects are still creating question marks. But as you say, some execution risks are perhaps resolved. For instance, NHAI only gives you completely acquired land. So that way, the land acquisition issue has been stopped. Final question to you, Mahesh. Would you go with this positive assessment or would you give a lot of weight to the worry that we are in a tariff-ridden world, a strife-ridden world, and that usually, it takes a brave CEO to put money when you don't know which product will be taxed how much in which country?
I would be cautious, and I think I'm always cautious. I'm cautious because most of the manufacturing industries, which are large capex, like steel is, I think, the biggest, where investment is happening in manufacturing, and that is susceptible to price changes, to dumping, to tariffs, and so on and so forth. So our biggest investment in manufacturing does face challenges. Our investments in manufacturing, to an extent, is problematic. I would expect CEOs to be circumspect and not be too gung-ho and going and setting up very large plants at this stage. Fortunately, fortunately or unfortunately, manufacturing accounts for only about 25 to 30% of our investments. So less of a risk over there. Infrastructure can continue.
Yeah, infrastructure can continue. That should not logically be bogged down by any tariff war. It's a very domestic industry. Gentlemen, thank you very much for enriching our understanding of a very, very complex topic. The positive that we got from CMI is that the amount of project proposals have doubled in the last 5 years compared to the previous 10 years or previous 6 years. And likewise, project completion are also up by about 40%. S&P Global Ratings believes that the capex in the next 5 years is going to be double what it was in the last 5 years. But both of them admit that there are red flags on the horizon. We have to keep our fingers crossed. A lot of policy issues itself can stymie these. On that note, we wrap up on Bazaar. Chartbusters coming.